Preparing for FP&A Analyst at RWE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like RWE? FP&A turns financial information into decisions. At RWE, I would connect operational drivers such as generation volumes, power prices, availability, project construction, and operating costs to budgets and forecasts. I would explain variances clearly, challenge assumptions constructively, and provide management with scenarios rather than just historical reporting. The role also requires strong collaboration with operations, commercial teams, accounting, and controlling. Ultimately, effective FP&A improves capital allocation, cost discipline, and confidence in RWE's energy transition strategy. While answering, focus on budgeting, forecasting, performance analysis, decision support, business partnering, and how FP&A helps RWE manage renewable investments, power market volatility, operating costs, and long-term value creation. Question 2. How would you build an annual budget for an energy business? I would begin with the planning timetable, templates, and agreed strategic targets. Then I would gather bottom-up assumptions for generation, availability, power prices, fuel, headcount, maintenance, projects, and overheads. I would reconcile those inputs with top-down targets, document assumptions, and challenge inconsistencies with business owners. After consolidation, I would perform reasonableness checks, sensitivity analysis, and management review before final approval. I would also establish monthly variance ownership so the budget remains useful after year-end. Make sure to cover the planning calendar, bottom-up operational assumptions, market inputs, resource plans, CapEx, financing, review cycles, consolidation, approval, and clear ownership of assumptions and outputs. Question 3. What is the difference between a budget, forecast, and business plan? A budget is an approved financial target, usually for the next fiscal year, against which performance is measured. A forecast is the latest estimate of what will actually happen and should change when assumptions change. A business plan is broader and longer term, linking strategy, investment, operating capacity, and funding. At RWE, the business plan might reflect multi-year renewable development, while the annual budget translates near-term commitments into measurable financial and operational targets. In your answer, distinguish purpose, timing, flexibility, strategic horizon, accountability, and decision use, while explaining how these tools interact within RWE's planning and performance management cycle. Question 4. How would you analyze a monthly actual versus budget variance? I would first identify material variances by business unit, account, and driver, then compare actual results with both budget and prior forecast. For revenue, I would separate volume, price, availability, and mix effects. For costs, I would examine rates, consumption, timing, and one-off items. I would validate the accounting data, discuss operational causes with responsible managers, and determine whether the variance is temporary or structural. Finally, I would quantify the forecast impact and recommend actions. Be sure to mention materiality, timing versus permanent effects, price-volume mix analysis, operational drivers, accounting checks, business owner discussions, corrective actions, and concise management communication. Question 5. Which financial and operational KPIs would you monitor at RWE? I would tailor KPIs to each business, but would generally monitor EBITDA, operating cash flow, CapEx, net debt, and forecast accuracy. For generation assets, I would add output, availability, load factors, realized prices, capture rates, balancing costs, and maintenance expense. For development projects, I would track spend against approved budgets, schedule, permitting, and expected returns. I would also include safety and emissions indicators because RWE's operational performance and transition objectives extend beyond purely financial outcomes. Focus on relevant metrics including EBITDA, cash flow, generation, availability, realized power prices, project progress, CapEx, OpEx, leverage, safety, and emissions, explaining why each supports decision-making. Question 6. How would you forecast revenue for a renewable energy asset? I would forecast revenue by modeling expected generation and the price received for that generation. The model would include installed capacity, resource assumptions such as wind or solar conditions, availability, degradation, curtailment, and maintenance downtime. I would separate contracted revenue from merchant exposure and apply appropriate forward prices, capture rates, and balancing costs. I would then stress test weather, price, and availability assumptions, compare results with historical performance, and clearly explain the forecast's key sensitivities. Make sure to cover installed capacity, expected generation, weather, availability, degradation, contracted versus merchant pricing, capture rates, curtailment, balancing costs, and scenario assumptions. Question 7. What is a driver-based forecast, and why is it useful? A driver-based forecast links financial outcomes to measurable operational assumptions instead of simply applying historical growth rates. For example, renewable revenue can be driven by capacity, generation, availability, and realized price, while personnel expense can be driven by headcount and compensation rates. This approach makes assumptions transparent, allows quick scenario analysis, and improves accountability because business owners can validate the drivers. It also helps FP&A explain changes clearly when market or operational conditions move. In your answer, explain operational relationships, transparency, scalability, ownership, scenario flexibility, and examples such as megawatt hours, headcount, maintenance rates, and power prices. Question 8. How would falling power prices affect RWE's forecast? The impact would depend on the portfolio's contracted, hedged, and merchant exposure. I would first quantify the change in realized prices by asset and period, considering capture rates and existing hedges. Then I would assess effects on revenue, EBITDA, cash flow, covenant headroom, project returns, and valuation. I would also consider whether lower prices reduce input costs or create development opportunities. Finally, I would present downside, base, and recovery cases, highlighting mitigation through hedging, cost control, and capital pacing. Discuss direct revenue effects, hedging and contracted exposure, capture prices, generation mix, EBITDA and cash flow impacts, valuation, sensitivities, and potential management responses. Question 9. How would you evaluate a capital expenditure proposal for a new wind farm? I would assess strategic fit first, then build an integrated model covering development costs, construction spend, timeline, capacity, expected generation, operating costs, financing, taxes, and decommissioning. Revenue would reflect contracted or merchant pricing, capture rates, and curtailment risk. I would calculate NPV, IRR, payback, and cash flow timing, then stress test delays, inflation, lower wind conditions, higher costs, and weaker prices. My recommendation would explain both the expected return and the risks that could change the investment decision. Be sure to mention strategic fit, development and construction costs, generation assumptions, power prices, operating costs, NPV, IRR, payback, risks, funding, and scenario analysis. Question 10. How do NPV and IRR support investment decisions? NPV measures the present value of expected cash inflows and outflows using a required discount rate. A positive NPV indicates value creation above that hurdle. IRR is the discount rate that makes NPV equal 0 and provides an intuitive percentage return. I would use both, but rely more heavily on NPV when comparing projects of different scale or timing. I would also review assumptions, risk-adjusted discount rates, funding constraints, and strategic benefits before recommending approval. Focus on discounted cash flow logic, time value of money, required return, project ranking, reinvestment assumptions, mutually exclusive projects, and why neither metric should be used alone. Question 11. What is working capital, and how would you forecast it? Working capital represents short-term operating assets and liabilities, commonly receivables, inventory, and payables. I would forecast each component using operational drivers such as revenue, generation volumes, commodity purchases, payment terms, settlement timing, and seasonal patterns. I would monitor days sales outstanding, days payable, and unusual movements, then reconcile the forecast to cash flow. In an energy business, collateral, margining, and volatile wholesale settlements can also create significant liquidity swings requiring close coordination with Treasury. Explain receivables, inventory, payables, operating cash conversion, business drivers, seasonality, payment terms, collateral, and how working capital actions affect liquidity and cash forecasting. Question 12. How would you prepare a cash flow forecast for RWE? I would build the forecast from operating receipts and payments, planned capex, financing flows, taxes, interest, and dividends. For RWE, I would pay particular attention to timing of power settlements, commodity purchases, collateral movements, construction milestones, and refinancing needs. I would reconcile opening cash to actual bank information, compare forecast with prior versions, and investigate timing differences. I would produce base, downside, and stress cases, then highlight liquidity risks and actions needed to protect funding headroom. Mention operating, investing, and financing flows, timing, working capital, commodity settlements, capex milestones, debt service, liquidity buffers, scenario analysis, and reconciliation to bank or treasury data. Question 13. How do you distinguish a timing variance from a permanent variance? A timing variance changes when an item is recognized but does not necessarily change its full year amount. Examples include delayed maintenance, a postponed invoice, or a capex milestone moving between months. A permanent variance changes the expected total, such as a lasting price increase, lower asset availability, or an approved scope change. I would review transaction detail, discuss the driver with the owner, compare against contractual or operational evidence, and update the forecast only after determining the correct classification. In your answer, explain expected reversal, accruals, procurement or project timing, structural changes, revised run rates, forecast updates, and communication of implications for both current and future periods. Question 14. How would you investigate an unexpected EBITDA decline? I would first confirm that the decline is genuine by checking postings, accruals, eliminations, and reporting mappings. I would then build an EBITDA bridge separating revenue price, volume, availability, mix, fuel or commodity costs, personnel, maintenance, overhead, and one-off items. For a generation business, I would investigate outages, weather, curtailment, and realized capture prices. I would quantify each driver, discuss corrective actions with owners, and determine whether the issue affects only the month or changes the full-year outlook. Cover data validation, revenue and cost bridges, price-volume mix analysis, asset availability, outages, commodity exposure, one-offs, forecast implications, and management actions. Question 15. Tell me about a time you improved a reporting or forecasting process. In a previous reporting process, several teams submitted manually formatted files, creating delays and inconsistent definitions. I mapped the data flow, agreed a standard template, added validation checks, and automated consolidation using Excel Power Query. I also documented ownership and introduced a review checklist before submission. The monthly cycle became faster, errors decreased, and managers received commentary earlier. The key lesson was that process improvement requires both technical automation and agreement on clear definitions, controls, and accountability. Be sure to structure the example using situation, action, and result, with emphasis on automation, controls, stakeholder collaboration, measurable efficiency, accuracy, and sustainable documentation. Question 16. Which Excel techniques are most valuable in FP&A? I use Excel to organize data, analyze drivers, and communicate conclusions. Strong fundamentals include XLOOKUP, SUMIFs, structured tables, pivot tables, Power Query, scenario switches, and sensitivity tables. I separate inputs, calculations, and outputs, use consistent signs and units, and build reconciliation checks to catch errors. I avoid unnecessary complexity and document assumptions clearly. For recurring reporting, I would combine Excel with systems or Power BI where appropriate, preserving control while reducing manual manipulation. Mention structured formulas, pivot tables, Power Query, scenario tools, data validation, reconciliation checks, dashboards, sensitivity analysis, and model transparency rather than complexity for its own sake. Question 17. How would you use Power BI or another reporting tool in FP&A? I would use Power BI to create a consistent, refreshable view of financial and operational performance. That requires defining a reliable data model, agreeing KPI definitions, controlling data access, and validating outputs against the general ledger or approved reporting source. Dashboards should let users move from headline variance to business unit, asset, or driver detail. I would keep the design focused on decisions, not decoration. The tool supports analysis, but FP&A still needs to interpret results and recommend actions. Focus on data modeling, consistent definitions, automation, drill-down analysis, visualization, governance, refresh controls, user needs, and how dashboards complement rather than replace financial judgment. Question 18. How do accounting and FP&A work together during month-end close? Accounting establishes complete, accurate, and properly classified actuals through close activities, reconciliations, accruals, and cutoff procedures. FP&A uses those actuals to compare performance with budget and forecast, explain drivers, and update expectations. I would coordinate closely on unusual entries, project costs, commodity settlements, and management adjustments, ensuring commentary reflects approved accounting treatment. A disciplined close calendar, clear ownership, and reconciliation between operational data and the ledger are essential for timely, credible management reporting. Explain the division between accurate accounting and forward-looking analysis, accruals, reconciliations, cutoff, management adjustments, reporting timelines, and resolving differences without compromising controls. Question 19. What accounting concepts should an FP&A analyst understand? I would understand enough accounting to interpret actual results correctly and challenge unusual movements. Important areas include accruals, provisions, capitalization, depreciation, impairment, revenue recognition, leases, foreign exchange, intercompany eliminations, and tax. I would also distinguish accounting profit from cash flow and management performance measures. For example, a capitalized project cost affects cash immediately but profit through future depreciation. That knowledge helps FP&A explain variances accurately and prevents operational decisions based on misleading timing or classification effects. Mention accruals, provisions, depreciation, capitalization, impairment, revenue recognition, leases, foreign exchange, intercompany accounting, and the distinction between profit, cash flow, and management reporting. Question 20. How would you assess forecast accuracy? I would compare each forecast version with actual results at total, business unit, and driver levels. Useful measures include absolute error, percentage error, and bias, although I would interpret them alongside materiality and timing. I would identify whether misses came from price, volume, availability, project timing, or accounting estimates, then discuss whether assumptions or process timing caused the issue. The objective is not simply to criticize accuracy, it is to improve assumptions, ownership, and decision usefulness in future cycles. Cover forecast versus actual comparisons, bias, absolute error, driver level analysis, timing effects, materiality, rolling improvement, and learning loops with responsible business owners. Question 21. How would you present a financial forecast to senior management? I would lead with the conclusion, expected performance versus target, the main drivers, and whether management action is required. I would use a clear bridge from prior forecast to current forecast, followed by key risks, opportunities, and scenario ranges. For RWE, I would explain how market prices, generation, availability, projects, and costs influence the outcome. I would keep supporting detail available but avoid overwhelming executives. Every slide should answer what changed, why it changed, and what should happen next. Focus on concise executive messaging, headline results, key drivers, risks, opportunities, scenarios, actions, visuals, confidence levels, and tailoring technical detail to the audience. Question 22. Describe a time you had to challenge a business stakeholder's assumptions. I would challenge assumptions with evidence rather than opinion. For example, if a team forecast unusually high output, I would compare it with historical availability, maintenance schedules, resource data, and contract constraints. I would ask how the assumption was developed, listen for relevant new information, and present a base case plus alternatives. If disagreement remained, I would document both views and escalate transparently. The goal is not to win an argument, it is to produce a realistic forecast and preserve a trusted partnership. Use a specific example showing respectful challenge, evidence, alternative analysis, listening, alignment, escalation when necessary, and a measurable improvement to the resulting plan or forecast. Question 23. How would you manage competing deadlines during budget and month-end periods? I would map deadlines, dependencies, and stakeholders early, then prioritize activities by business impact and reporting dependency. I would use a tracker with clear owners, prepare recurring analyses in advance, and communicate risks before deadlines become urgent. During peak periods, I would protect critical controls, such as reconciliations and review checks, rather than sacrificing quality. If priorities conflict, I would confirm trade-offs with my manager. Staying organized and communicating early usually prevents pressure from becoming avoidable rework. Mention prioritization, materiality, dependency mapping, early communication, standardized work, deadline tracking, quality controls, escalation, and maintaining accuracy under pressure. Question 24. What risks are especially important when planning for an energy company? Energy planning requires a broad risk view. I would consider wholesale power and commodity prices, weather-driven generation, asset availability, grid constraints, balancing costs, inflation, interest rates, regulation, permitting, construction delays, and counterparty exposure. I would translate each risk into financial drivers, probabilities or scenarios, and potential mitigations. For example, a delayed wind project affects CapEx timing, expected generation, revenue, financing, and strategic targets. Good FP&A makes those connections visible rather than presenting one deceptively precise forecast. Discuss power and commodity prices, weather, asset availability, regulation, permitting, construction delays, inflation, interest rates, counterparty risk, grid constraints, and scenario-based mitigation. Question 25. Why do you want to join RWE as an FP&A analyst? I want to join RWE because it combines a meaningful energy transition mission with a complex, analytical business environment. Renewable development, power market volatility, major capital programs, and operational performance all create valuable FP&A challenges. My strengths in financial modeling, variance analysis, data quality, and stakeholder communication would help translate those dynamics into useful decisions. I am also attracted to the opportunity to learn from experienced finance and operational teams while contributing to disciplined investment, reliable forecasting, and long-term value creation. Be sure to connect RWE's renewable growth strategy, energy market complexity, finance development, analytical strengths, collaboration, and motivation to support disciplined investment and sustainable business performance. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.